Alright, let's dive into something that's been bubbling up in the currency markets recently: the euro's surprising strength against the Canadian dollar. Now, on the surface, this might seem like just another day in the Forex world, but personally, I think there's a lot more going on here than meets the eye. What makes this really interesting is that the euro is holding its ground despite some pretty mixed economic signals coming out of Germany, which is, the powerhouse of the Eurozone economy. So let's break it down. First off, German retail sales took a hit in June, dropping 1.1% month-on-month. That's steeper than expected, and it's a sharp reversal from the 1.2% rise we saw in May. On an annual basis, it's even more concerning: a 0.2% dip after a 2.1% growth the previous month. Now, if you take a step back and think about it, this should be a red flag for the euro, right? Consumer spending is a big deal, and a decline like this usually spells trouble for a currency. But here's where it gets fascinating: the euro isn't budging. Why? Well, in my opinion, it's because the markets are looking beyond these retail numbers and focusing on something else entirely: the manufacturing sector. The S&P Global Germany Manufacturing PMI hit a 4-month high of 52.2 in July, up from 50.3 in June. That's a clear sign of a rebound in factory performance, and it's not just Germany. The broader Eurozone manufacturing PMI also ticked up to 51.9. What this really suggests is that while consumers might be pulling back, businesses are stepping up. And that's a crucial distinction. What many people don't realize is that manufacturing can often be a leading indicator of economic health, and right now, it's painting a much rosier picture than retail sales. Now, let's talk about the Canadian dollar, because it's not just about the euro's resilience, it's also about the CAD's struggles. The Canadian dollar is heavily tied to commodity prices, particularly crude oil. And guess what? Oil prices have been on a downward spiral lately, thanks in part to easing geopolitical tensions. President Trump's decision to pause military strikes against Iran has significantly reduced supply risk concerns, and that's taken some of the wind out of oil's sails. From my perspective, this is a double-edged sword for the CAD. On one hand, lower oil prices can ease inflationary pressures, but on the other, it weakens the currency's appeal as a commodity-linked asset. What makes this even more intriguing is the role of European equities. Analysts at Deutsche Bank pointed out that European stocks outperformed as Brent crude fell by nearly 7%. This raises a deeper question: are investors seeing Europe as a safe haven in the face of geopolitical uncertainty? It's possible. The pullback in oil prices has tempered immediate concerns about energy costs and inflation, and that's creating a more supportive environment for European markets. A detail I find fascinating is how quickly these dynamics can shift. One day it's all about inflation fears. The next it's about manufacturing resilience and equity gains. Now, let's bring Coker into the mix. His recent speech scored a 5.6 out of 10 on the FX's speech tracker, which is below his usual average. That's interesting because it suggests a slightly softer tone, even as he flagged geopolitical risks and inflation concerns. What stands out to me is his emphasis on data dependency. The ECB isn't committing to any hawkish moves just yet. They're waiting to see how the data plays out. Personally, I think this cautious approach is smart, but it also means the euro might not get a significant boost unless we see a reacceleration in economic indicators. If you look at the currency heat map, the euro's strength against the Swiss franc is particularly notable. That's another sign of its resilience, but it also highlights the broader trends at play. The euro is finding support in multiple areas: manufacturing, equities, and even a bit of safe haven appeal. Meanwhile, the Canadian dollar is caught in the crossfire of falling oil prices and a shifting global risk landscape. So what's the takeaway here? In my opinion, this isn't just about euro to Canadian dollar. It's about the bigger picture. The euro's strength is a testament to the market's ability to look beyond short-term setbacks and focus on underlying fundamentals. And the Canadian dollar's struggles remind us of how closely tied currencies are to global commodities and geopolitical events. One thing that immediately stands out is how interconnected these factors are: manufacturing data, oil prices, equity performance, central bank rhetoric. They're all pieces of the same puzzle. As we wrap up, I'm left with a thought-provoking question. How sustainable is the euro's current strength? With mixed data and a cautious ECB, it's hard to say. But one thing's for sure, this is a story that's far from over. So what do you think? Is the euro's resilience a sign of things to come, or is it just a temporary blip? Let me know in the comments below. I'd love to hear your take.